So good morning, everyone. Welcome to our Small Business Solutions Series workshop. We are sponsored by David Yasa and the Growth Coach of Greater Portland. David's not here with us today, but if you're ever interested in business coaching and sometimes in a rather challenging economy, it's always nice to have someone to bounce ideas off of. I would definitely encourage you to talk with David. So we are excited about our program today. I think it's really important for small businesses to have this information. Lots of changes at the federal level in terms of tax reporting. And actually, shockingly, some of it is beneficial. So that's always, so tax and benefit in the same sentence, hardly ever used. But it's nice to be able to do that today. And we have, in my opinion, the smartest tax accountant in the state of Oregon, Katie Eyre, a tax partner at Fordham and Company. The second smartest tax accountant is Blair Walker, her partner, who is also the treasurer of the Washington County Chamber. So I'm delighted to have you both here today. And Katie has got a very long resume, not because she's old, but because she's just accomplished a lot. Her resume is included in our promotion of this program. I don't want to spend any time wasting any of Katie's time doing that, but has been a legislator at the Oregon, a representative who obviously was involved in the revenue forecasts and the revenue agency of the state of Oregon with her time in office, and so has also kind of understands how the sausage is made at the state level as well. So Katie, I am going to be delighted to turn this over to you. And I know, can you share a screen? You're all set.
I can, and let me see if I can do it and not act like I don't know technology. So, okay, so there's my screen share. So can everyone see that?
Yeah. Got it.
All right, so just some opening comments. Just to introduce Blair Walker, my partner, is on the call, as Deanna mentioned. And also I have one of my managers by the name of Lucas, who's on the call with me. And Lucas is my sidekick in understanding and evolving this tax bill. Whenever there's a new big law that comes out, and this was a big law that came out. It just was enacted. It signed on July 4th, very theatrical day to sign this one big, beautiful bill act. And so it was done by design. So we've kind of been drinking it up a little bit ever since. There's a lot to do, but I've curtailed this specifically towards small business, because this is important for small business. So it's not going to touch too much on international tax issues. It's actually not going to touch very much at all on it. And it's also not going to be curtailed for publicly traded type entities. And that's important to know. So thank you, Deanna, for that warm welcome. And oh my goodness, here I am. It's not letting me slide through it. There we go. There's Lucas, handsome debonair guy that he is. So the One Big Beautiful Bill Act goes by a couple of different names. You hear OB3A, you'll hear Tax Act, you'll hear HR1, you'll hear a lot of names out there. And the tax legislation part of it is a very small part of this whole bill. The bill is very big and robust. We're not going to get into all of it. We're only going to talk about the tax portions of it. But what it did in the tax section is it extended a lot of the last big bill we had, which was the Tax Cuts and Jobs Act of 2017. It added some new provisions and it ended some provisions. So most of the Tax Cuts and Jobs Act pieces of legislation that have really kind of underwritten the underpinnings of our tax law and market growth and all of those things over the last few years were set to sunset at the end of 25. And there were some other changes, changing dates too, but this basically extended most of those provisions. And in general, it made permanent, and permanent in air quotes, it made some of the things that were temporary, made them permanent. But in anything government, permanent means just for now until we change it later, if they do. And then there's some that are temporary, which means it's only for a few years. And things that tend to be temporary, when talking about how the sausage is made, temporary tax provisions, what that means is we have to account for a budget over a certain period of years. And while we want to make something permanent, we can't afford to in the current budget. So we make it temporary, knowing that we can revisit that in a few years and extend it again or make it permanent at that time. Other parts of the bill have to do with agriculture, a lot in there with agriculture. Farm lobbyists were great, food security, national security and military spending, energy, natural resources, a whole lot was done in there, good and bad, depending who you ask. Medicaid and Medicare changes, eligibility, those types of things. And then a lot of other parts had to do with college grants and student loans, in addition to some other things. So those are things that are in the bill, but we're not going to address. So on the bill, there's a couple of big general opposing perspectives. The supporters say that it's going to promote economic growth and it's going to reduce government spending. But then on the other side, we have the opponents that say it unfavorably impacts social programs and increases national debt. And let me tell you, both can be true. Both can be untrue. And there's degrees of both that are accurate and inaccurate. And so these are really value statements that are made, but we're not going to get into the political aspects of it as much as just discussing this. Judge Learned Hand was an appellate judge from decades ago. He he wasn't on the Supreme Court, although a lot of people think that he was. And in tax law, he said some most incredible, profound things. But this is one of his quotes that I love. There are two systems of taxation in our country, one for the informed and one for the uninformed. And what that means basically is tax law is not for the weak of heart. And understanding some of the nuances is where, you know, your CPA, your tax advisor, comes in. Okay, now let's get down to the nitty gritty. But before I do, I want to tell you some caveats. We're going to talk in generalities with some, some specifics, but in general, none of this should be relied upon for your own tax position. What you need to do is talk with your own tax advisors about your own unique position. I have to say that the law is still developing. We're still digesting it. There's a lot in there. We need some additional guidance on some of it because the IRS, other agencies are supposed to come out with some things as determined in this law that will impact the tax reporting. We expect some technical corrections on some things when tax law is passed. After all said and done, people go home. Then the bureaucracies, the agencies look at it and they're like, oh my gosh, there's some ambiguity and things like that. And so that's, I just want to caveat that out there. So don't rely on this in and of itself. I know I'm probably going to say something that's not 100% accurate because of where we are in understanding this law, but I just want to make sure that you have the bullet points here. We're going to talk about effective dates. We're going to talk about individual tax because we're small business, so everything impacts us individually. We're going to talk about business tax. We're going to talk about a little bit about energy incentives. We're going to talk about payroll and 1099 reporting issues. I know Tao, that's something important to Tao in her role as an example. So let's talk about effective dates. So some items in this law are retroactive. For example, the employee retention credit, or also known as employee retention tax credits. And then there's some retroactivity with research and experimentation expensing and credits. We have an opportunity in those two areas, and there's a couple others where we can go back retroactively and amend prior returns, or we have some options to handle what happened retroactively in a prospective manner. I'm not going to get too much into R&E expensing unless any of you has something specific that you want to talk about with that, or a specific question, and I'll give it my best shot. In 2025, there's a lot of good, juicy things that take effect immediately. Some go back to January 1st of 25, and some go back to January 19th of 2025, or excuse me, January 20th, really, which was the inauguration date. That's why we have a January 20th date in there on some things. And those things are, from business perspective, we're going to go in more detail, where you get 100% bonus depreciation. Overall itemized deduction, overall limit has been removed. The increase in Section 179 threshold, that's another big one. If you have a lot of interest in your business, you may have been limited on how much you can deduct. There's been some changes there. The formula's changed. There's an increase in the child tax credit as well as the refundable portion. There's a deduction for tips, for overtime pay, for automobile interest, and for being 65 and older. The big one that a lot of people talked about was the state and local deduction that had been limited to 10,000. That's now been raised to 40, but we'll talk more about that. Expensing, you can now go back and expense. Research and experimentation is the technical term, but it's research and development is what most people talk about it, where previously you couldn't expense it. Starting in 22, you had to capitalize it and amortize it. And then there's the sunset of energy credits. And then if you contribute to a college plan for a loved one in your life, the expansion of the use of distributions occurred. Those are 25 things. Prospectively, starting in 26, there's some changes that have to do with charitable contributions, both individually and for corporations, gambling limits, the estate and gift tax exemption. If you have been profitable, you're probably familiar with the qualified business income deduction. Casualty losses have been expanded, mortgage interest, on, and we'll talk more about that. And beyond 26, we have some other changes related to ozone designations, which is opportunity zones, and then more sunsetting of clean energy in the business area. We're going to get into some of these, not all of these. So the effective dates are kind of all over the board, some retroactive, some in 25, some 26, and some further beyond. So let's talk about individual taxes. I kind of broke these up into a couple categories. The first category are things that we've been used to since 2017 that are basically the same and with a little bit of tweaking to them. And so I don't want to get too much into these, but we have had the benefit of reduced income taxes. The highest tax rate for individuals is now 37%. It was going to go up to 39.6%. And we also had some more favorable lower tax brackets for the folks down in the 10, 12, and 22% that were going to go up. We have increased standard deductions over the last few years. That's continuing on. And we have an increased, the child tax credits continuing on at an increased amount, and even better. Child and dependent care credit is basically the same, except a little bit expanded. There's this net business loss exclusion, which kind of, if in what that gets to is, if you at the individual level, if you have business losses greater than business income, you're limited to $250,000 per individual. A married couple is $500,000. Well, that's continued. There is a little bit about that. If you are in a significant loss position and this is something that applies to you, then I recommend that you talk with your tax advisor immediately. A planning tip on that is because there's some thresholds that will decrease in 26 to a less favorable position. I don't want to get too far into the calculations. You may want to accelerate losses into 25 so that you can maximize on some of that. So just an FYI, if you find yourself having a lot of business losses greater than your business income at the individual level, talk with your accountant before the end of 25. The adoption credit's been enhanced. We've always had an adoption credit, but now they're allowing $5,000 to be refundable. Before it had never been refundable. And then this one, the estate and gift tax exemption. It was set to sunset after 25. It was going to be around $7 million. It's currently just around $14 million in 2025. And now it is now permanently at $15 million. And one of the other things I didn't say is what this bill did is a lot of things that were stagnant in the tax code, they've now set up for it to be eligible for inflation. A lot of these thresholds I'm talking about that's one of them. So we're now good. $15 million federal estate tax exemption. And you don't have to pay federal estate tax or gift tax, you know, if you gift away and die with $15 million or less, subject to inflation. Caveat here for Oregonians is that our Oregon estate is only $1 million. So if you die with $1 million or more, you have a filing requirement, and depending on how your estate is set up, you may also have a state tax set up. There's some movement in the estate legislature, in the Oregon legislature, to increase the estate tax above $1 million. The one that's got the most legs is $7 million. But I think there's in Oregon that's going to be a hard sell. Oregon does have one of the worst estate exemption thresholds and tax rates in the nation. So Washington, though, just changed their tax law. If anybody lives in Washington state, we have a lot of clients that do. I don't want to get too far in the weeds there, but their top tax estate tax rates now, I believe, at 35%. That's their tax rate. Anyway, we're still digesting what all of that means. Okay, then in the Tax Act, there are some tax law changes where they're the same, but they made significant differences in the dollars involved. So we talked a little bit about the SALT deduction. And by the way, Lucas, if I screw up on anything, chime in.
Yep.
So thank you. So for the SALT deduction, it's been limited to $10,000. If you itemize your deductions, the $10,000 includes both real estate and income taxes that you pay to states, or sales tax. And there might be some other little minor state and local taxes you might pay, such as Metro, supportive housing, you know, some other things like that. So it's been limited to $10,000. So now what they did is they said it's $40,000, which is great. And I think a lot of taxpayers will now be able to benefit from that. However, if you end up with $40,000 of state and local taxes, there's a good chance that you also have a lot of income. And so this $40,000 can be eroded if your income's very high. But what the new tax law says is, at the very least, you're always going to get at least $10,000. So it is $40,000. And for most of us, we'll be able to take advantage of that. But if your income's too high, it can be eroded. The other thing is the Tax Cuts and Jobs Act of 2017 changed the alternative minimum tax, which is like a parallel tax system to the regular federal income tax. They changed it very favorably. So one of the things we've observed is not as many clients were subject to the alternative minimum tax. This tax law has changed it. So I think we're going to see more people that are subject to alternative minimum tax that weren't previously subject to it. So still digesting what that means and what planning is there for that. But if your accountant has ever told you that you were close before, get a tax projection for that, and see what you need to do for 25 and 26 before the end of the year to make sure that you're able to stay out of alternative minimum tax, unless you want to be in it, which is certainly possible too. So the new items, these are new individual taxes. So there's a lot of commentary you're hearing about that, about $10,000 of automobile loan interest is deductible, which is true. It's subject to a phase out. So if your income's too high, you won't be able to deduct it. There's also some other criteria I'm just going to go over briefly. There's much more in it. It has to be a new vehicle purchased 1/1/25 or later, and the final assembly of the product of the vehicle has to be done in the U.S. So then you will also be issued a 1098, which from the financing company, that says this is the interest you paid on it. So one of the things about this from a planning perspective, if you have children and you're a high income earner and you want to buy a car for your child, well, you might consider them taking out the loan, them buying the car, you help them out and have the car in their name, they may be able, if they have income, to take advantage of this deduction where you may not because your income's too high. So just an opportunity there, but this isn't going to really help anybody with a higher income. You're going to quickly phase out. We hear a lot about the Social Security, non-taxable on Social Security, which didn't happen because there's a special law that says you can't include any changes to Social Security type things in a tax bill like this. So in lieu of that, what happened is a $6,000 deduction for people that are 65 years or older. And that is a deduction that you get to take against all your other income, unless you're a high income person. I think the phase out is $75,000 for individuals and $150,000 for married filing jointly. And that's when the phase out starts. So if your income gets too high above that, you're going to have close to no benefit from the $6,000 deduction. We hear about no tax on tip income and no tax on overtime. Those are true, but they're limited, and they're also subject to income thresholds. So the tip income, it's the first $25,000 is not taxable, subject to some thresholds of income. I think, Lucas, do you know off the top of your head what that threshold is? Is it like 75,000 again for individuals? It's around there.
That sounds about right.
Yeah. Okay. Actually, no. For tips, it's 150,000. I just pulled up something. 150,000. So it's quite high. 300 if you're married filing joint. And the tip income has to be reported on a W-2 or a 4137 odd form or a 1099. The important thing here is if you're in the restaurant business or something and you're self-employed and you receive tips, you also you're eligible to exclude the first $25,000. However, you don't have a form that this is reported on, so we think we're going to see a technical correction on this little element. There's no tax on overtime. First $12,500 per taxpayer. It has to be reported on a W-2. So if you haven't already started tracking overtime separately from regular wages for W-2 reporting purposes, you're going to need to, because it will be reported separately on a W-2, and that is also subject to thresholds, income thresholds. And I think, Lucas, do you know off the top of your head on that one? That one's probably.
I'll take a look here.
It's probably around 75,000 if you're single, or no, 100. That one is also 150,000 if you're single and 300,000. One of the things too, a lot of people that have their own businesses have been saying they're going to start all of a sudden their income's going to be on considered overtime, versus other ways that small business owners can get paid to them. There is an exclusion in there, or a clarifying statement that says the overtime, it can only be considered overtime if it is required by the Federal Fair Labor Standards Act. So basically, if you had an employee working for you and you're required to pay him overtime, and there's some other state requirements that may also be eligible, but if you're required to pay an employee overtime under certain conditions, then that's when the overtime is considered for this provision. So, and on the tip income, by the way, one thing I meant to say, there's some ambiguity there. It must be voluntarily paid. So a customer comes in and tips voluntarily, and the employee reports that as income. Fabulous. It's on a W-2. We're great. But often when you go into a restaurant for parties of 6 or more, 8 or more, there's a mandatory 20% or whatever threshold tip on there. That appears at this point that tip income does not qualify because it is not voluntary. However, I anticipate that we will see some changes to that, or some clarifying language to that. So just an FYI if you happen to be in the restaurant business. Charitable contributions. This is a 2026 event, but there's some things that you may want to do for 2025. Charitable contributions for individuals are changing in the fact that starting in 26, whether you itemize or not, if you make any charitable contributions and they have to be cash, you can have $1,000 of your charitable contributions deducted. even if you don't itemize. Has to be cash, but you can do that. I think it has to be cash. I don't think stock qualifies for that, and definitely not like the Goodwill type you're giving away things, household items and such. Those won't qualify. It has to be $1,000, or it has to be cash. Up to $1,000 will be deductible. Here's the other one, though, that we need to be aware of. Starting in 2026, there's now a floor that you have to exceed in order to deduct anything for itemized charitable deductions. So if you are going to make a lot of charitable contributions, the first 0.5% or 0.5% of your adjusted gross income, which is basically your income before your itemized deductions or your qualified business income, some other things, you have to surpass that 0.5% before any of your charitable contributions can be deducted. So one of the things that we recommend doing that, first off, that's a 2026 start date. So if you happen to be someone that contributes a lot of things to Goodwill, you go through and you clean your house out, well, clean it out really good before the end of 2025. And if you're going to itemize deductions, give it all now, because even that's going to be subject to this 0.5% floor next year. And then if the 0.5% of your adjusted gross income is a large number every year for you that you may not benefit from, another way to get around this is to bunch up your charitable contributions into every other tax year. And what that means is you're only having to meet the 0.5% floor once every 2 years rather than every year. It may or may not be a lot of money depending on your tax situation, but that's one way around it. So casualty losses, we have had a lot of clients actually with the fires, our forest fires. For casualty losses, it's been that it had to be federally declared disaster areas. Now they're allowing state declared. The next new item for individuals are the Trump accounts. I think we're already hearing murmurs that the name's going to change, but let's talk about what this is. Starting in 2026, you can start saving money on behalf of a child into this account, and they can't take any money out of it until they turn 18. And then at age 18, you can convert it into a Roth IRA, or they can take the money out and go on a vacation or something, who knows what, or pay for college. But they can't take it out till they're 18. But the interesting side to it is starting in 26 for babies born January 1st of 25 up through, I think, the end of 28, might be 29, the government is doing a pilot program where they're going to contribute $1,000 into a Trump account that has been established for that child. So we're going to hear more about this, but basically it's $1,000 free money for a baby. And then the family and some other people can contribute to it. It's a great way to start a savings for a young person to turn it into a Roth IRA when they turn 18, and they can start their savings ahead of time. The downside to it from a human perspective is, putting money into it, because the child, when they turn 18, has control of it and can take the money out. Do we know how a baby's going to be when they're 18? And we've seen some 18-year-olds not the best with money. So, you have to make a value statement there. But the $1,000 is free money under this pilot program. So that would be a reason to open up a Trump account. The other one, credit for contributions to scholarship granting organizations. You can get a $1,700 credit for contributing money to an organization that issues scholarships, which basically means if your child goes to a private school, K through 12, you can make a contribution to that school if they and get a tax credit for it if they issue scholarships. There are other organizations they have scholarship funds to give to kids. Now, that is true. However, there's some qualifications for what is a scholarship granting organization. And there appears to be that the state has to kind of sanction who these scholarship granting organizations are. I'm not quite sure how this is all going to fall out. And knowing the state of Oregon, that it is not likely that Oregon is going to be a very willing participant in this, because it basically will allow credit for money going towards private tuition. So I don't know how that's going to fall out. So that is out there, still to be determined. And then if you are a gambler and you lose money, you can only take 90% of your losses as an itemized deduction. And get this, it can't be any greater than your gambling income. So for most of us, that's not an issue, but for some of us with online sports betting and things like that have become more prevalent, it is a little bit more of an issue. If I go out there today and I make $100,000 win, and I have to recognize $100,000 of income. Tomorrow I go back to the same gambling site and I lose it all. I have $100,000 loss. Well, I can only deduct $90,000 of it. So I have to pick up $100,000 of income, but I only get to deduct $90,000 of the gambling loss, and I'm taxed on $10,000 that I don't have. So, that it is what it is.
Katie, that sounds like the price of not being too smart.
That's right. Well, that's exactly right. And also, if you're a professional gambler, there may be some other opportunities there. But yeah, for most, I'm not that smart, and which is why I don't gamble that much. Maybe $1 at a time. I'll lose $10 and hate myself for it. So let's talk a little bit about individual taxes, miscellaneous things. Premium tax credit has to do with your health plan. There's some changes to the eligibility of it. Most of the changes are now only if you have a Social Security number. You can no longer just use a taxpayer identification number. And some of the other changes are you already had to be in the U.S. lawfully, but now you have to be in the U.S. lawfully and be a resident. So, some people, I guess, were coming into the U.S. lawfully, weren't residents, though, of the U.S. and were qualifying for this health insurance and getting the premium tax credit, even though the residency was another country. And then there's some eligibility issues having to do with the coverage months. So I know a lot of small business people actually do go out to, the exchange and other places to get this. So there's some eligibility requirements, and you have to meet certain criteria from the outset. And if you aren't qualified from the outset, then
so Nikesh, for the sake of standing back,
you're not going to be
maybe
covered.
step on a die and see if there is something weird going on in the waveforms. So that
Swetha, could you go on mute, please?
Original data production. But now on CMA, it's not working for some reason.
Swetha, can you go on mute?
I'm wondering if it's some timing issue or something.
So with the new lot, CDPL.
Thanks. Yeah, thank you.
I took control. There you go. All right. So now, so that's that. On HSAs, if you happen to have HSAs or offer HSAs, used to be that it had to be a silver, gold, or I think there's even platinum plans. Now bronze and catastrophic plans only will qualify for HSAs. College plans, I'm not going to get into a lot of details here, but eligible uses expanded a bit. So mostly it had to be higher education and related expenses. They seem to have allowed credentialed programs, which I take to mean vocational or technical or trade schools. Now are eligible uses for 529 plans. If that applies to you, we can drill down on that. Now money being transferred through Western Union or MoneyGrams, all those other things going out of country are now subject, starting in, I believe, 26, are subject to a 1% excise tax. And if you are transferring money through a bank or using a bank card, that's okay. You're not going to have this excise tax. But if it's going through another alternative source, then you will be subject to this excise tax. And the sender has to pay it, and the person that's transmitting it has significant penalties if they don't collect it and pay it. And then if you have an ABLE account, which has to do with people with challenges, disabilities of sorts, if they're able to work, things like that, there's some other mechanisms in there. So for individuals, that's really all I wanted to share. Lucas, anything you wanted to clarify on that?
Nope.
Okay,
No.
Thank you. Now let's get into business taxes. Assuming I can change my screen. Hold on here. It's not letting me all of a sudden. There we go. Okay. So business taxes, here's what's basically the same with a little bit of changes, is the Section 199A qualified business income deduction. If you've had a pass-through entity and have been profitable in the past since 18, that comes through to you, and then you may be able to take 20% of it as a deduction against your other income, called QBI. What this has come through is said if you have at least $1,000 of qualified business income, you're going to get at least $400 of a deduction. That doesn't sound like much, but it's better than nothing. But because there's some other limits, and basically we don't have to pay attention to those limits if you have at least 1,000. We do have to pay attention to them, but you're at least always going to get $400, even if you don't meet those other limits. There's some qualified small business stock. If you sell it, they've expanded that for excluding that gain. It's very technical. We've heard about the CHIPS credit, having to do with manufacturing of chips, basically. They've enhanced that credit. Oregon missed out on getting a lot of that money here for our manufacturers. Meals, deductible business meals for on-premise employee meals. Used to be that if you provided meals for your employees on site for your own convenience, you can deduct that. They've done away with that, where there's no deduction available. However, I think there's going to be some clarifying information on that. What they're talking about, what they were trying to talk about there, are the large companies that have cafeterias on site for their employees. So all of the expenses related to the salaries, the chefs, the servers, the bus people, all of that, those are no longer deductible by the employer. However, if you're an employee who occasionally provides lunch for your employees, bringing it in, at certain intense times like we do during tax seasons, things like that, I think they're still deductible, but we're still looking for clarifying language on that. So that's the one thing there. And then if you happen to provide childcare for your employees, that's expanded a little bit, but it's nominal in true effect for most people. Now here's the same laws, but with, excuse me, oh my goodness, don't scroll, Katie. Same laws, but with substantial changes. Bonus depreciation, we've heard about that. Prior to this tax act, the bonus depreciation was going to be 40%. What this is when you buy new equipment, you get to accelerate depreciation on that new equipment, and then take the to a certain portion, and then take the rest over the regular depreciable life of the asset. Well, initially under the Tax Cuts and Jobs Act, we could get 100% bonus depreciation. This is not 179 expensing, which is similar but different. This was bonus depreciation. So it started stepping down in 23 to 80%, 24 was 60%, 25 is 40%. This bill said, nope, we're going back to 100% for assets acquired and placed in service after January 19th. And that's because January 20th is the inauguration day. If you acquired an asset January 1st of 25 through January 19th of 25, its bonus is only 40%. Or if you were under contract prior to January 20th, 25 for a new asset, it's also limited to 40%. So you're going to need to kind of, look at your assets this year and make sure that they qualify for 100% bonus depreciation. Most taxpayers, most business taxpayers want to take advantage of that. Now there's also, we'll get into 179 expensing. That's where you can decide, well, you know what, I should be capitalizing this asset, but rather than capitalizing it and depreciating it either through bonus depreciation or through the life of the asset, I'm going to elect to expense it, treat it like an expense. And it's an election you have to make. Other rules apply to it. There was $1 million limit, subject to inflation. Now what they've done is the limit is $2.5 million. So the first $2.5 million of assets that you that you acquire, you can make this election to expense it. And then it starts you start losing some of it the closer that your asset additions get up to 4 million. Above 4 million, you don't qualify for it for that year. If you happen to have a C corporation, not an S corporation, but a C corporation, charitable contributions were always limited to 10% of your income, your taxable income. So if you made charitable contributions greater than 10%, you couldn't deduct them in the current year and they could carry over into the following years. So that rule's still in place. But now there's a new law that says that charitable contributions in a C corporation are only deductible when they're in excess of 1% of your taxable income. So individuals have this 0.5% floor. C corporations have a 1% floor. So that may impact some corporations. Again, the tax planning tool there is to bunch them up every other year if you have a C corporation. And that's just a planning technique you can do. Interestingly, if you make charitable contributions and don't meet the 1% floor, those charitable contributions, based on my read of the language, that what you've made, even though you didn't make the 1% floor, those are carried over into the next year, and you can deduct them in the next year. If you make the 1% floor, but not the 10% ceiling, you're done. If you make charitable contributions above 10%, the excess above 10% is carried over into the next year. So, and when I've tried to digest the science behind it, it actually made economic sense to me. So I'm good with that. Okay, so then we talk about business interest limitation. If you are someone that has a lot of loans in your business, and there's a lot of businesses that do, or real estate, there's some exceptions there. But if you are someone that has a lot of loans triggering a lot of interest, and with interest rates lately, I think more businesses this applies to, you are limited. You can't take any interest above 30% as a deduction, and that was based on taxable income earnings before your interest deduction and taxes. Now what they've done is they said, okay, we're going to be easier on you. It's going to be your income before interest and taxes and depreciation and amortization. So they're giving you a higher taxable income to figure out your limit on, which is great. More businesses are going to now be allowed to take this deduction. And then I don't want to get into the weeds, but there's an ordering rule as to if you have interest that isn't just deductible, but you may have to capitalize it into, like, you're building a building, you have to capitalize certain interests there. There's an ordering rule now where even that interest may be limited. So if you have a lot of interest in expense, talk with your advisor to make sure you're not hit with any surprises on your 25 return. Some new items for businesses. This is a big one. Real property. If you are building a plant for manufacturing or for the production of tangible personal property, and there's some things out there, but basically if you're building a manufacturing plant and you're manufacturing something that can be touched, then we can take the cost of that real property, which otherwise would be depreciable over 39 years, we can now take 100% depreciation for that. Lucas, do you recall, is that a 25 or 26 state?
I want to say 25, but let me look here.
And if that applies to you, there's also some contract dates. It has to be placed in service, I think, sometime in 29. Contract has to be started at a certain date. So if this applies to you and you're actually establishing a plant, this is big. We had someone who just put a plant online in 24, and that's a shame because they could have greatly benefited from this. But now they're stuck 39 years on most of the costs there. While Lucas is looking that up, I'm going to move on to the farmland property. We have a lot of farmland here in our area in Washington County. there's a new law that says if you sell farmland, that you now can take 4 years to pay the taxes, and they're not due until the April 15th of the original filing deadline. You pay 1/4 each April 15th for 4 years. To meet this, the property had to have been used for at least 10 years prior to the sale in farming, and you have to sell it to a qualified farmer who's going to farm it for at least 10 years. And the sales contract actually has to say they're going to farm it for 10 years. So you can't just sell farmland and convert it to developable land, that's not going to be used for farming and do this. It has to be farmland sold to be continued for use as farmland 10 years before and 10 years after. Lucas, did you find that out?
Yes, it's a 2026, so it's beginning after December 31st, 25.
Okay.
So it is a 26 item.
Okay.
Yeah.
Yeah. Thank you.
Yep.
And then this next item it's going to impact, I think, more people than they initially realized. And as I was drilling down on it, I call it a prickly pear. When you have a partnership or an LLC taxed as a partnership, the partners sometimes provide services to that entity. And it's pretty common in the tax world, and you may have one of these. And they provide services. And you take cash out of your company, either for payment for your services or as a distribution return on investment. If you take cash out subject for payment of services, in all likelihood, that's going to be subject to self-employment tax. Sometimes you'll take cash out and it's subject as a return on investment, but it's disguised as a sale. So you put property into a partnership 1 year and somebody else put in cash, and the next year the partnership's paying you out cash and you didn't do anything for it. You're just getting cash, and we're saying it's return on investment. The IRS says, wait, hold on, that might actually be where you sold part of your property. And so the regs say for that disguised sale, the tax law says for that disguised sale that I just described, there needs to be regulations. IRS has provided regulations for that. But where a partnership provides distributions for your services, it says that the IRS has to provide regulations. The IRS has never provided regulations on that because it is a prickly pear issue. So now what this means is the IRS can come in and recharacterize payments made to you and say, no, they were really for services, even though there's no regulations out there. And so I think this is going to impact people, and we're going to see more of it. I believe it's a prickly pear. And I believe if you're in that situation, you need to talk with your advisors to make sure that whatever you're paying yourself or not paying yourself for services, and you have an LLC or a partnership that's filing as a partnership, that you have a reasonable basis for why that money is coming out the way it is. Okay.
And
now
quickly, I just this is one of those odd ones. This is effective after July 4th of 2025. So
this prickly pear one?
Yes, yeah.
Okay.
So just anything Q3, Q4 here, just keep that in mind.
Yeah. So that's one of those things you're going to want to make sure that you have a conversation with your tax accountant, and make sure that you're all good. And sometimes on things like that, you just kind of have to do the best you can, document the best you can, and be reasonable, not be greedy. And my experience is even if a taxing agency is successful upon challenge, they don't hit you with penalties and things like that because you had a reasonable basis for what you've done. And so we're not hearing a lot of conversation about that, but I think that we will. So just some miscellaneous other items related to payroll and 1099 reporting. Starting with the 2026 tax year, which will impact the reporting done in January of 2027, the 1099, when your company issues these 1099s for non-employee compensation or miscellaneous, the threshold was $600 previously, it is now $2,000. And the good news is that $2,000 is subject to inflationary indexing. So that is good news there. 1099K if you happen to be someone who had to issue it or someone who receives a 1099-K, the de minimis exception, it was, I think, $600 and 20 transactions or something for third-party networks to do it. Now, the minimum threshold for any one recipient is they had to have been paid $20,000 and have at least 200 transactions. So, you know, if and that basically is credit card reporting agencies, credit card that, you know, you receive money for sales from a credit card company. This is now the threshold. So that's those. For if you issue payroll, you now have to separately report overtime pay. We touched on that on the employee's W-2. So make sure your payroll system is accommodating that going back to January 1st of 2025. For employees to deduct the tip income, it must be voluntary and not mandatory, which we discussed already. They also, this isn't really a payroll issue, but the tip income is also industries like beauticians and masseuse therapists, other things like that. And then for HSAs, we talked about bronze and catastrophic. I'm not going to talk a lot about this, but energy incentives kind of went away completely now, and an expansion of qualified energy generators such as nuclear is now considered good energy sourcing now because technology has changed. But basically the clean vehicle credits, you know, you go out and you buy a car, that expires just a couple weeks on 9/30. So if you don't buy one of those vehicles by 9/30, you no longer qualify for the credit. Residential energy credits, those, if you're doing something in your home, those have to be installed by 12/31/25. And then there's some other commercial energy credits, which are sunsetting at various dates, mostly prospectively 26 and 27 and beyond. There's some other resources. I think for non-tax people, the best place to go, you can go to the irs.gov website and find some things. I'm always hesitant to send non-tax people there because the IRS posts things in a very kindergarten format that isn't nuanced enough. And the best resource is your tax advisor on these things. And Lucas and my contact information if you need us. So any questions? I'm going to take my screen off of sharing. Any questions for me or Lucas? Excellent. That's great. Deanna, I think you're on mute. Do you want to jump in? There you go.
Yeah, thank you very much, Katie. This was very comprehensive. Just a last call for any questions that might have come up along the way. Wow, that means it was extremely comprehensive and a lot to
I have a question.
Okay, excellent, Kimberly. How are you?
Yeah, I work with a lot of subcontractors, and so I, create a lot of 1099s. And so I was wondering, um, if I don't pay them more than $2,000, I no longer have to issue a 1099 NEC.
Yes, that's starting in 2026.
Okay.
2025, you still have to follow the $600 threshold.
Okay. Yeah, thank you so much.
Sure.
That is good news. Those things are TDS.
Yes, they are. And subject to inflation, we've been at $600 for decades, and $600 used to mean a lot. Now $600 is, going to a restaurant and taking a friend. So, so $2,000 subject to inflation will be very meaningful.
Katie and Lucas, thank you so much. Any other questions? Final questions?
I have another one. I'm so sorry.
Not at all.
I have a lot of charitable contributions in a year, mainly to my church, and there are cash that come. So cash is defined as deductibles from my checking account, or and I don't pay those by credit cards, but so I could in 2026 I could get $1,000 deductible because of those. Now, what if you make a charitable contribution less than 1,000? Do you still get $1,000 if you?
Yes, starting in 26. So that's for the $1,000 deduction, whether or not you itemize, you get the $1,000 up to $1,000. And yes, that is if you pay less than 1,000. So if it's between $1,000 and $1,000, you will be able to deduct that. And let me clarify one more thing, Kimberly, is you mentioned credit cards. If you make a charitable contribution through your credit card, that will be treated as if it's cash.
Okay.
So when I say cash, I mean anything that isn't like stock or other property or household items, those types of things. So if you contribute cash or through a credit card or a bank transaction or real cash check, anything like that, it will qualify for that up to $1,000. And one other point, Kimberly, is if you also itemize, you still can qualify for the up to $1,000 that everybody gets. And you can also take charitable contributions on your itemized deductions. So you can actually get both if that happens to be the situation. I think AJ, do you have a question?
I do have a couple of questions, nothing too in-depth, just, with the LBAC this morning, jumped on the call a little late. Where can we get this recording?
Deanna?
Oh, it will be on our YouTube channel, and we'll also send it out with our upcoming email in case you missed it.
Perfect. And as I review that video, are you available for questioning and consulting, Katie?
Oh, always.
Okay,
So yeah, the contact information is at the end of it, and you can reach out to Lucas or myself, and we can see, what your questions might be, and we're happy to help with that.
Perfect. Appreciate that. Thank you.
Sure.
All right. Any final questions? I see that our sponsor is able to join us, David Jassa. David, did you want to say a few words this morning?
Well, thank you so much, Katie. That was awesome. The information you have shared is invaluable. Thank you so much. All I want to say is, again, these are not easy times. These are quite tough times on everyone, and the goal is to find ways to benefit from any opportunity that gets our way. The goal is for all businesses is to increase revenue, try to control expenses, and expand on their profits. And if tax benefits can help us with that, let's do it. Thank you so much, Katie.
David, thank you so much. And as I said before you were able to join us, that, oftentimes when it's challenging times, you need someone to talk to, and the growth coach of Portland metro area is a valuable resource during difficult times. So this is not our only Small Business Solutions Series workshop of the month of September. We actually have a bonus one coming up on the 24th, and I'm super excited about it. It will be from 9 until 11, and we have 2 folks that are joining us, and this will be in person at the chamber, and it's utilizing AI for your small business. So if you're kind of trying to figure out what AI means for your small business, is it a waste of my time, or is it something I can implement, and what does that look like? This is a class for you. It's a small fee from 9 to 11. It's $15, and I would say get registered. 2 great experts that are really going to help you really understand the utilization of AI for your small business and save you time and resources. It is 11 o'clock, and I want to thank you all again for spending time with us, and look forward to seeing you again. Take good care.